Joining us here on The Business of Money, we have David Shapiro, Mia Kruger, and Wayne McCurry. Thank you all for your time. And if we look at the week in hindsight, I suppose we need to chat about Growth Point and the broader trend when it comes to property in general, specifically your office spaces. And some of the verbiage that we're hearing from the CEOs out there is that this hybrid reality will exist from here on out, and that some of the equations being bandied about are 70% at home, 30% at the office, 60% at home, 40% at the office. So if you've got property in your portfolio, and David, let's start with you, where
this one is a Wayne. When you always go to property, you go to Wayne first.
Sorry.
He knows a mirror, he knows it backwards.
Wayne.
I always just echo his views. So
Wayne,
talk to Wayne first.
I second.
Well, thanks for that vote of confidence there, David. Look, property, as we know, has probably been in the spotlight with this whole virus. Now, let's divide property up into 4 components. The first one, the good one, is industrial. I don't know why it's called industrial. It's actually just warehousing and distribution. But that you literally can't buy enough of it, because that suits the ordering online type of scenario that's been accelerated by the virus. So industrial property is fine. Retail property, interestingly enough, is recovering. The experience that the property industry is having on vacancies in retail is actually relatively subdued, given the state of the economy and the state that we find ourselves in. I mean, there have been some negative reversions. In other words, when people sign a new lease, it's less than what their previous lease was, but the escalations in those leases still look okay. So in other words, retail looks all right. At maximum, you're probably going to suffer a 10% reduction in the value of your retail assets, but that's about it. And it's interesting, just as a side comment, when Bid Corp issued their results. Now, as we all know, they're big into essentially services and food delivery and logistics in Europe mainly. They said quite clearly that they detect no discernible change in consumer behavior where countries have returned to some form of normality. In other words, very few lockdown restrictions. So I think retail's okay. And let's talk about the problem is offices. Offices, unquestionably, it has changed. Now, whether it's 60% at home, 40% at work, we don't know yet. When we look at a few big US companies, they're saying you have to come back to work. We want you here. But something has changed there. And there's probably a permanent 20-25% drop in the value of your office assets. And currently, look at Growth Point, their vacancies in office are probably 17 or 20% vacancies, whereas previously they were 4 or 5%. So that has changed. And then the final one for South Africa in particular is what assets do you have overseas? If you're in Europe or Eastern Europe, you're probably in a bit of trouble. If you're in the UK and the USA, you're probably fine. But quick summary, the value of your asset has reduced by 15 or maybe at maximum 20% on all of your assets. The share price has reduced by 40%. So in other words, despite all the bad news, there probably is still some value in property shares if you're prepared to wait. Now, the property shares have been the best performing sector this year so far, but that doesn't mean anything. There is still value there.
So you're saying that the downside was overdone. Mia, do you have exposure to property?
We do, and we have limited exposure though, but I agree with Wayne is that, the pain taken by the market was more than, more than what the actual balance sheet pain was. So that comes down to a good investment. But you have to be very selective, especially from a South African point of view. And I absolutely agree with what Wayne said in terms of the industrial portfolios. Those are the ones you want to focus on. You want to focus on the companies that offer you those distribution areas, that focus on the warehouse sides, especially when it comes to Google, Amazon, it's putting up new businesses in South Africa, and those networks and server warehousing is something that I think worldwide is very profitable, and it's going to grow. It's going to keep on growing in South Africa as the hub for Africa that these companies already said they want to be. So things like that, little niche areas, are the ones that we like and we prefer. And then of course, property, it's still property and infrastructure, and that's what we like, especially on the renewable side. But yeah, my
David,
focus
is
lies
that
there.
a warm up in the property space? Are you exposed in any of your portfolios? There's not a space.
Not at all. You know what? It's a long cycle. Property is a long cycle, and I agree in the sense that we're coming out of the bottom, we're coming out of that trough, but I think it's going to take a long time before it stabilizes, and one can come in and feel comfortable about it. Yes, I'm sure there's recovery potential there, but for my money, I think we can find better stuff at the moment. And it's economically driven. And Wayne was right. We don't know what the shape of offices are going to look like when we get out of this. And even on the retail side, we're still deciding what it's going to look out of. So I'd rather go elsewhere. Keeping an eye on property, it doesn't mean I just dismiss it, but I think it's a cycle. It's going to take a long time before we're back to a reasonable level.
Wayne, given your depth of understanding of the sector, where's the value to be had right now? Which stock would you favor?
Well, look, I suppose you've got to go for the big diversified companies. So Growth Point springs to mind, to be honest. It's got all the right diversification of their asset base. And I suppose you've got to look at the companies that are highly geared, because those are the ones that have taken, you avoid them, those are the ones that have taken the biggest strain. So I would just go for redefined Growth Point, just go for the big guys, the big companies.
Let's talk commodities, David. Before we started the session, you were revving Wayne up about his view on commodities. So you continue with your bullish stance on commodities.
When I say I'm bullish, I'm not ultra bullish, but I'm watching the area very carefully. I was impressed that Biden got his package through. And I think what's quite interesting is that the shift is now towards the United States, away from China. Not that China, you've got to dismiss China. I still think China is a massive consumer of commodities. But I think that once Biden gets this through Congress, I think you're going to find more countries following suit. And then it works into what Mia has been talking about, this complete transition, the infrastructure project, even the projects that she's being involved in here. So I think there's going to be a nice underpin for commodities. And watch that oil price. That oil price ain't going down now, simply because there's no new capacity being added. And I think we can add that to a lot of other commodities as well. So I just find it an area, I'm saying, it's going to give a nice underpin to this market and maybe to some of the industrial businces offshore. But I'm not a wild, mad commodity bull.
You're not Neil Froneman.
No, but Neil's got a lot of skin in the game. He puts the family fortunes there.
He's got reason to talk up those commodity prices.
Yeah.
Look, I mean, you must understand that on commodities, two things. The good news peaks the day before the prices fall. So don't expect to fall in a bull market, or don't expect bad news in a bull market. The prices peak the day before they fall, and they are cyclical. Now, copper's in a long-term bull market. It doesn't mean the price won't fall from 10,000 to 9,000 to 5,000 and go back up to 10,000. That can happen. Copper's in a long-term bull market. Platinum PGMs are probably in a long-term bull market. But items like iron ore, even oil that David's mentioning, I mean, these are heavily cyclical companies, commodity prices, and they can fall and go up quite easily. And we've had one of the biggest commodity bull markets that we've ever had. And if the past is anything to go by, the prices will be lower in 2 years' time than where they are now.
Mia, I mean, I know we get your view regularly
Yeah.
on the commodity space, but I think just to close out this discussion on commodities, remind our audience of where you stand.
Well, I'm somewhere between David and Wayne, because the fact is they both got very, very valid facts there. It is very cyclical. You need to know when to get in, when to get out. It's not something you hold for the long term. But currently, I agree with David. We are in this this very strong growth uplift worldwide, where Biden is going to spend a lot of money on infrastructure. We see still a lot of demand coming from China, and I think as the economies worldwide start to come out of COVID, there'll be a matter of uptake in these commodities, and that's only sort of the iron ores and things like that. So I think there's still some legs to drive this cycle. But it's like Wayne says, if you want to go into commodities, you definitely need to know when to get in and when to get out. And but I don't think it's quite the time to get out yet.
Now, I want to bring a concept where we talk about a stock of interest from each of your respective perspectives, so to speak. And Wayne, I'm going to start with you. So give me your stock of interest.
Well, look, it's actually, I'm very interested in one aspect that's happening, and that is the extent of, let's call it, industrial South Africa revitalization in comparison to last year. So today it came out, interesting enough, Hudaco. I mean, the turnover's up 30%, the profits are up, I don't know how many hundreds of percent. They declared a dividend. Now, you know, you got to actually go to their website and read the actual full announcement, because SENS now just do the short form announcement, which is so annoying. But anyway, putting that aside, look, there's a full recovery look at Omnia as well. I mean, Omnia, the agricultural business and their mining business are doing extremely well. Now, Hudaco is very similar to Invicta. It's just industrial, non-retail South Africa, and the results are looking good. So we've got a very strong mining cycle in our favor. In respect of Omnia, we've got a very strong agricultural recovery in our favor. And I think this is catching a few people a little bit by surprise. I mean, lots of economists have now upped their growth forecast for this year from 3.5% to 4.2%, etc. Now, of course, we're only getting 4.2% because last year was -7%, but still 4.2 is a lot better than -7%. So there's my topic. Let's call it industrial South Africa and Hudaco.
You're giving us two, Hudaco and Omnia.
Yeah, you can take two, yeah.
We'll take that. Thank you. David.
It was a similar theme. I was going to go along a similar theme, but I'm going to break away there, because I think there's a lot of sense in what Wayne is saying, and it's something we've been looking at. You're going to make money there. But I'm going to go across to Nike and what their numbers came out, which were sensational. And why they're sensational is they've changed the whole way in which they market. They go direct to customer, you know, rather than through retailers and wholesalers. But it's not only, and it's America that came back strongly, even though China was slightly down. So look at what these retailers are doing. And the other thing is their fashion. They've changed their fashion completely. You know, you used to get white Nikes or black Nikes. Now they come multicolored, multi-dimensional, multi-designs. So I think a very interesting concept there. And I would watch all of them: Adidas, Nike, Lululemon, any of those fashion leisure wear companies, Under Armour. Just have a look. Nike stands out though at the moment. Great results.
I saw your eyes light up, Mia, when this is in your space. I mean,
absolutely. I run with Nikes. I've always done, and I think it's a great outcome that we've seen, as David mentioned. You know, it's a share that we've held for a very long time, and I think this just actually plays out into their strengths, and they are the market leader. So no doubt, I second that strongly.
And
but I'm going to
add something else.
Yeah. So I'll focus on one of our offshore renewable energy companies that we like and that we invested in. It's Orsted, and the price has come back quite a bit. It's the largest energy company in Denmark, and it's the world's most sustainable energy company, claimed this year, and they are the biggest producer of offshore wind. They want to be net zero development of energy in 2025. So they're really a leader in this area, in this market, and they offer you a great entry opportunity at the current levels. So yes, definitely something to consider if you haven't moved into renewable energy yet and you want to.
You know, I'm going to start building my portfolio on the back of the stocks of interest, and we'll revisit on a regular basis. So Wayne McCurry, Mia Kruger, David Shapiro, thank you very much for your time and joining us here on The Business of Money.